with failure, these are the events that I decided before I invested money. If this happens, I'm taking action. Define that action. It may be you're going to call for redemption. It may be that you're going to push others for foreclosure. Whatever it is, define it before you get there. Because too often we rationalize wherever we are at that point in time. We want to hear a salvation message. And so whatever that is, we're willing to listen to it while, the core of us, or maybe our spouse, is telling us, get the hell out of this thing right now. So define what failure looks like up front. Define what actions you're going to take if failure triggers happen, and then take the action.
All right, David here. Back to you with a second half of my conversation with Mr. Burt Copeland. If you missed it last week, go back and catch last week's segment on what a CFO is, a Chief Financial Officer. You'll really appreciate what a Chief Financial Officer can do for your business and why you might consider needing one. Today, we're going to talk about what we do in Freedom Founders in terms of due diligence. That's the vetting process of looking at the unique opportunities that we have in the alternative investment space. Why we need to have a better understanding of what the financial management, the cost, the allocation of capital in terms of record keeping, and how our investments and money is being carried through any particular investment through people that we maybe like to know, like, and trust, but what's behind the curtains. This is very important, and I hope you enjoy this conversation with Burt Copeland. The additional aspect that we have found inside Freedom Founders, and let's just kind of cut to the things that we do in Freedom Founders, which is focusing and helping our members invest in alternative investments outside of Wall Street. And what is that typically for us? Well, it's real estate. People inherently think good things about real estate. I think most people do. And they think real estate's great. I like to have some diversification outside of the markets. How do I go do it, right? And in Freedom Founders, we're about our members who are busy in their own practices, their own professions, don't want to typically get their hands, into the actual real estate like I did when I was younger, and actually buying properties and managing tenants and contractors. And that's what I call hands-on, which is fine at an appropriate age. But when you've elevated on up and you have additional capital to invest and you're still very focused on your own business, being more passive is generally the way people want to go. The question is, how do I do it? And I think the bigger question today, Burt, is where are we in the market cycle? There's the media, of course, puts out their verbiage on all aspects of where we are politically, economically, and you take it for what it is. But I think without taking any particular stand, we can say the markets are volatile. We're probably peaked or past peak, and going to see some different corrections in different respects to the economy, different asset classes in real estate. And this is where I think the would-be or want-to-be investor in real estate potentially can get lost in the weeds and actually get hurt without understanding, well, what am I actually doing? We're not in an up market like we had for the last 14 or 15 years. We're in a sideways, probably trailing down market. Is this a good time or bad time to get into it? And my answer, since I asked the question, would be, well, it depends. There's always a place to enter any market if you understand what you're doing, or you're connected to people who have access points and the knowledge base and the resources to help you define what is you're looking for and what is a good versus potentially bad investment. What you've brought to Freedom Founders is a financial acumen and experience that allows us as a community to leverage you in a positive way to actually look at different real estate investments that we are considering to be appropriate for Freedom Founders, but not yet 100% there, by looking at the certain aspects, not an audit, but certain aspects of the financial components of various operators, managers, fund syndicators, that kind of thing. That's where we've really benefited with your help, and it gives us certainly not a risk-free ability to invest in anything, but it gives us
no such thing, my friend. No such thing.
It gives us an additional level of understanding and to be able to make our own decisions with a basis of being better informed. So I speed out a lot there. Why don't you pick it up where you want to, and maybe give us a little bit of your frame of reference of real estate from your own experience, and then let's kind of talk about some of the things that you think are particularly important that potential investors should look at, or have someone help them look at if they're going to invest in any particular real estate class today.
Sure. So I'm going to start out with some of the things that you just had at the beginning of those statements. And really the question is why don't people invest in real estate? What prevents a dentist, a CFO, or whatever from investing in real estate? It's generally three things. It's, I don't know how, I don't understand it, and I don't have the time to bridge the gap between my ignorance and the opportunity. And frankly, and I'm not on my sales pitch soapbox here, but within Freedom, we talk about three things. We provide education. You provide it, not we. That's the wrong pronoun. Opportunity, right? And then we also do credibility. It's that credibility piece that we have changed radically over the last 3 years, because we went from being, hey, we have good people, these look like good types of investments, to now we want to make sure they're good. So we've added a lot more scrutiny and accountability to that picture. Because again, I always talk about the three-legged stool: education, opportunity, and credibility. So as we have migrated and evolved in this accountability and credibility thing, we really started to get into, and I think we're doing something that, nobody at our level is doing. Nobody. And that's really diving into what is the financial risks and profiles of the people who are bringing these opportunities to us. Because at the end of the day, we're relying on not only their good word, we're relying on their actual ability to execute. So we've talked about this before, that we're going to look at the operating company, because we want to make sure the operating company is financially sound, because if that's in distress, then the decision-making is in distress. Then we're going to look at the structure of the investment itself. And is there anything weird going on there? But then after that, assuming that all those things work out, we're really going to focus on, are the risks of this transaction properly identified to the investors? And then really start challenging ourselves to look at what could cause this to go down? What could cause this to fall off a cliff? What are the triggers that are going to upset this apple cart? And if the apple cart gets upset, what do I look like when the water goes out? Because that's really very important. So on some of the things that we looked at on debt deals, okay, there's less risk as long as the tenants stay there and they have long-term contracts. There's less risk as long as they get the property turned around and it becomes a leasable deal, but a proven history. And then on others, we're going to look at, if something goes wrong, like on one of the opportunities, it was all about completing the building and then getting the debt replaced, the Freedom debt replaced by a bridge debt that ultimately became agency debt. And so the risk bar is, hey, do they run out of capital to complete these projects? Well, they shouldn't, because of the monies that we're making available. And then B, the biggest risk is if they can't get the bridge loan for whatever reason when they need to take the bridge loan to take us out. And as long as the investor knows that that's the quintessential risk in that deal, and they know what their opportunities are if that happens. So in that one deal, we made it very clear, this is the biggest risk, right? The other risk about completion deal, we solved that by having them insert more capital into the project. But on the refinance deal, it's like, that's just a risk you're going to take. And if interest rates go wildly up, it's going to be more difficult to make this viably economic to get this thing refinanced. And then the downside protection that they need to make sure that they understand is, your protection is to foreclose, to claw the equity back out of the soft equity that can only be realized if you foreclose and take it back out to market. Right. And then we kind of define how much cushion do you have. But it was very clear that if this thing goes sideways, you will be protected if you take action. And here's the action that you'd have to be willing to take. If you're willing to take those actions, you should be fine. If you're not willing to take those actions, or you get frozen up by the fear, then don't do this deal. Hopefully from that, the people can self-select in or out based upon their own risk factors. Because let's face it, as well as anybody, I have no clue what is the risk of pulling somebody's teeth. And I assume the same thing of most of our dentists and orthodontists in the room. They're weaker about what is the real downside or risk related to some of these investments and transactions. Providing that clarity and then making sure that there's capability and accountability behind that, I think is where we really add unique value.
And taking action when necessary, or just taking action on making decisions, or taking action by learning to ask the right questions is something that I really find has been a huge benefit of the community overall, because each one of us as individual investors learning the ins and outs of investing, our members learn from each other. They learn from you, they learn from me, they learn from Larry, our securities attorney. They get this education, but when action needs to be taken, you've got the community at large, and you get to leverage that to do whatever needs to be done, or even on the front end, as you and Larry have many times made distinct suggestions. Could almost call them mandates, because we're not going to do the deal if you don't do these, but suggestions on the front end to an operator, a good operator who is
Suggestions with leverage.
Yeah,
Suggestions with leverage.
That's a good way to put it. Right. I like that better. That's a kinder and gentler way to put it, Burt. But we have that opportunity, and that's what makes deals that would be, or investment opportunities that might be okay or average in a relatively good market, much sturdier or stronger, more resilient, maybe more risk mitigated in an economy or market which is today a little bit uncertain.
Yeah. And like a lot of these things, there is no one good deal. Good deals are only good if they fit your risk and horizon profile. And if you don't understand that when you're going to select a deal, then go back and rehash your notes on your blueprint day. And I'm not trying to be harsh, but if I look at somebody and says, they're offering me 17%, for me, naturally, I'm going to look at who else is offering 17%, or they're offering 11%. Who else is offering 11%? And what does that deal look like? Right. What are the risk profiles of what that deal looks like relative? Okay, if everything's at 12%, let's see what the risk profiles look like relative to my time frame and relative to my risk appetite. But if I have somebody that's offering me 11%, and it has about the same level of securitization or whatever as a 16% deal, then why would I take 11? Right. And if I have other things that lack that structure and it's 15%, it's like, I'm not so sure that's enough to get paid for this kind of risk. But the most important thing that I'll tell you that I challenge the companies that I manage is we too frequently think about what success looks like. So when you buy your lottery ticket, how often have you already spent the $1 billion? Right? Every time. You haven't thought about, well, gosh, what else could I have done with the $10 I just blew on lottery tickets that I'm never going to win? The same thing is true with our businesses. The same thing is true with our investments. So what I encourage people to do, as far as driving, let's take action, is define what failure looks like before you put your money in. And then with failure, when you hit, it just hit X, Y, and Z. These are the events that I decided before I invested money. If this happens, I'm taking action.
Right.
Define that action. Right. It may be you're going to call for redemption. It may be that you're going to push others for foreclosure. Whatever it is, define it before you get there. Because too often we rationalize wherever we are at that point in time. We want to hear a salvation message. And so whatever that is, we're willing to listen to it, while the core of us, or maybe our spouse, is telling us, get the hell out of this thing right now. So define what failure looks like up front. Define what actions you're going to take if failure triggers happen, and then take the action. Right? You may not be 100% correct, but that's what you decided on in a rational mind before the stuff was on the fan.
Burt, how about financial controls? I mean, that's your whole world. Having a good controller, having great books that where you can see the flow of funds, you can see the segregation of accounts where that's appropriate. That's something that we know even good people that are maybe good intentioned operators, if the financial management's not there, they can get into a world of hurt just because they don't know what they don't know. What sort of things let's say, what sort of things have you found in your history of, again, good people seemingly to run good company and operations, a good culture, but the books were just a mess, and all it takes is one shoe to drop somewhere, and they're in a world of hurt.
There's a couple of triggers that I really look for. Is, what are you doing with my money when I give it to you? Where does it go? right? And when do you start paying me money relative to the returns you've talked about? And there's a couple other triggers, but we'll stay on these two for the first. So what happens to my money when I give it to you, David? What I want to hear is that you're going to set it aside and it's going to sit in a bank account, segregated, identified separately on your financial statements until it's deployed as productive asset. Ideally, quite frankly, I'd prefer that your PPM says, hey, you're going to start getting a return as soon as we deploy it to a productive asset, but there is no guarantee about how fast that happens, right? So that's okay. That's a part of the risk that I'm taking. What I don't like is two things on funds. It goes in and starts getting commingled with funds from other entities that are outside of what I invested in. Don't like that at all. I talked about it at the event. Now, while that's a fantastic treasury management technique, it means that we've lost accountability on my specific funds. If I invest in IBM, I invested in IBM, right? I didn't invest in IBM and then a myriad of pools of stuff, everything else. No, I invested in IBM. So I like it when the money stays in the entity and is deployed for a purpose. Don't like commingling of funds, especially with outside funds, because again, I lose accountability. The other thing that is really important, and this came up a couple of times, David, I invest money with you and you guarantee me that you're going to start paying me a return within 60 days, 90 days, whatever. But there's a lack of transparency about, is my money into a productive asset, right? So that should be 1 for 1. You pay me a return when it's into a productive asset. If not, then what can happen is I'm going to start paying you return. Your money's not into a productive asset, which creates a problem about how am I paying that return?
Right.
I'm either paying that return out of excess profits or I'm paying that return out of new money received and raised.
Yes.
So if you have PPMs that say that, ask the questions about how do we measure and monitor what amount of your assets are productive and producing income? And my equivalency there is occupancy. Whether it's what percent of your assets are producing, what percent of your units are filled with good paying tenants, it's an occupancy question. And what are their abilities to monitor that occupancy stat? Percent of assets that are producing income, percent of tenants that are paying income. That's really the key. Because if they don't have that and they're guaranteeing you a payment within a set period of time, irrespective of accountability about what they did with your money, it's a problem. It is a big problem. The other thing that I think is a real red flag is money's come in, they go out, they be lent out or whatever to go buy assets. The assets are refurbed to another entity, and then they're moved back in. Why is that a problem? Because now we're dealing with related party transactions and an asset having the potential to be repriced. And I'm okay if it gets repriced as long as there's a process and there's a means to evaluate that this transaction between two related parties, two entities owned by the same company, are done close to an arm's length transaction. So there we're going to look at, hey, I really don't care about your opinion, David. You're smarter at this than I am. Well, what data are you looking at, relying on to make this decision about what the asset coming back in should be priced at? Hopefully you're looking at market data, which says, here's the average selling price per square foot. Here's the average cap rate for this level of property. Here's the average rents or whatever the case may be. That's helpful. And as long as there is a set process. But if it's a prayer and a hope and a whim, no, that's not good. So hopefully that answers your questions about some of the biggest risks that we've seen and some of the biggest risks people should look out for.
Let's kind of summarize on this question, Burt. I know that when you are on our behalf for Freedom Founders, doing some review and some, let's just call it investigation into the practices of a particular operator, you go directly to their CPA or their controller or whoever that person is that is, quote, in charge of the flow of funds. And you start by just asking them some questions. What would be some triggers when you ask a certain question, and what are some triggers that would just say something's not quite right here, even though you haven't gone deep yet?
So I tried to peel this onion back slowly because I don't want to raise alarms about the questions behind the questions. You and I have participated in some of these calls, but I will ask sometimes leading questions about their total assets under management, and then start asking questions about the amount of assets that are in operating or productive deals. And what I'm looking for is how well do they know those stats?
Right.
How well they know the stats is almost as important as the stat itself.
Mm-hmm.
It's like, well, I don't know. And it's like, oh, geez, man, I just threw up in my mouth. Um, and then I'll ask questions about weird transitions that I see on the balance sheet or income statement. Like, what caused this? What is this account? How does the money flow in and out of this account? And what I'm trying to understand is the movements of money through the organization and in and through the assets. There should be good clarity on that. There should be a good understanding on that. But if we get into stammer mode, it's like, well, let me go check on this. Then what you're doing is you're talking to a controller that has deferred responsibility to somebody else about how the accounting should work. Not good. Not good. Or they're the picture on the stamp and they have no idea what's inside the envelope.
Yeah.
So if they can't answer those basic questions about it, and then in one case we found out by looking, it's like, hey, look, you have all this interest expense, but I don't see any debt on the balance sheet. Oh, and that's how we discovered that there was another entity that we needed to look at.
Mm-hmm.
And then they brought that one. I was like, okay, at least now we have a complete picture. Otherwise, I thought there was some shell games going on here.
So for me, Burt, I think the best way I can provide an analogy to many of the people who are listening today or people who have invested in real estate alternatives, private equity, is to us, you're the financial doctor. We know how to read X-rays. We know how to ask the questions of a patient to drive the symptoms that lead us to a diagnosis. You do the same thing. If someone gave me all of the data, the financial data that you just alluded to, I wouldn't know where to begin. I would be lost in the morass. That's why you consolidate it for me. But you actually go in and you do that diagnostic work and then provide us, the investors, with the data we need to say, well, is this something we want to do or something not? Or as many times we do, we just pass, on that particular operator or that investment, unless we can reconstruct and, as you and Larry have often done, restructure more safety valves so that we know where our money is and it's being kept, as you said, siloed in the actual investment asset.
Yep.
You want to add anything to that? Is that a fair analogy?
It is a really good analogy. And the other thing that I love that you talked about at the last event is when people understand what's going to happen when they come into IRC. We've had a lot of people that just self-eliminate, whether it's people says, this isn't the right room for me anymore, or it's people that have been curious about coming into the room and says, what, no. And that's fine. Asking and defining the tough questions up front is the most efficient way to make sure that the right people in the right room. And the metaphor there is like the security sign you have in front of your yard. That sign is more powerful than the actual security system you have itself.
Yes.
Because it's like, okay, this is not going to be worth the pain of possibly being lit up an alarm. And, I don't know if if he's a Second Amendment guy or he's not a Second Amendment guy, but I don't want to take that chance anymore now that I see this sign, because he's going to wake up.
So true. So true. Well, Burt, I really appreciate your time today. People can find you at New Life CFO, but do you want to give any other contact information we can put here in our notes for this episode?
Sure. My email is burtc@newlifecfo.com. And my phone number, if you want to reach out directly, and especially for those people that are reading my write-ups, you can call me at 214-315-2275. I would encourage you to shoot me an email, and I'll send you a link to my calendar so we can get something locked down. Because unfortunately, David, if it's not on my calendar, man, I don't care how many times we talked about it, it ain't happening.
Doesn't happen. I totally understand. You got to protect your time for sure at all costs. Well, Burt Copeland, appreciate your time. Appreciate all that you have done for me, for Freedom Founders, and I know for many, many clients that appreciate the great work that you do.
Well, thank you, David. And thanks for the opportunity to even be able to do this.
My pleasure.
All right. Take care, man.
You too. If you enjoyed watching or learning from this video, please leave a like and subscribe to my channel for more content. If you have a question about any of my content or this specific video, just please leave a comment down below. And as always, stay focused on your freedom. I'll see you next time.